Welcome to the Opening Bell Report.
We've got this massive analysis report you sent over, and I have to say, diving into this research, we really need to start by addressing the elephant in the room regarding the real estate market.
Oh, absolutely.
Because we're talking about a concept that pretty much everyone thought was completely dead, buried, and paved over. The iBuyer model.
Right.
You probably remember the hype. These are those companies that offer to buy your home directly for cash, do some, light renovations, hold the property, and then flip it back onto the market.
It was the absolute darling of the tech meets real estate world for a few years there. Silicon Valley thought they could just algorithm their way into flipping houses at this unprecedented national scale.
And it worked.
It worked beautifully, yeah, right up until the macroeconomic climate violently shifted.
And that is exactly where I want to start. Because to understand the thesis you asked us to look into today, this whole idea of billions in debt cleared and the bull case for open stock, we really have to look at the bloodbath that just happened.
It really was a bloodbath.
Let's take you back to the recent past. Interest rates suddenly spiked. Mortgage rates basically doubled overnight. And the panic in the real estate sector was immediate. We watched Zillow, which was this absolute titan in the space with their Zillow Offers division, just completely lose their nerve.
Well, they realized their algorithms were buying homes at peak prices just as buyer demand completely evaporating.
Right. And the fallout was spectacular. Zillow didn't just scale back. They shut down their entire iBuying division and laid off thousands of people.
Which sent shockwaves through the whole industry.
Definitely. Then Redfin essentially looked at the exact same math, threw their hands up, and bailed out of the space entirely. The conventional wisdom just became that iBuying was fundamentally flawed, that it was this zero interest rate phenomenon that couldn't survive in a normal economic environment.
So the Titans retreat, the dust settles, and the landscape looks like a graveyard.
Exactly. But standing right in the middle of that graveyard is Opendoor, ticker symbol OPEN. When everyone else fled, Opendoor was left holding what looked like a ticking financial time bomb.
They were sitting on billions of dollars in depreciating real estate inventory, coupled with absolutely suffocating corporate debt.
Suffocating. The narrative across every financial outlet was that Opendoor was just the last dinosaur waiting for the meteor to hit.
Yeah,
But the analysis report you sent us tells a completely different story.
it really does.
Our mission today is to unpack why Opendoor didn't just survive, but how they might have actually pulled off one of the greatest balance sheet cleanups in modern real estate history.
It's a phenomenal turnaround story. And what makes the analysis report you shared so compelling is how methodically it upends that mainstream doom and gloom narrative.
Because it looks bad on the surface.
Oh, if you're just doing a casual glance at recent headlines, the situation at Opendoor looks, frankly, terrible. But this report demands a much closer reading. When you look at the underlying mechanics and the structural changes they've quietly made while everyone else was looking away, it reveals a calculated financial masterstroke.
Okay, let's unpack this, because the very first thing the analysis report points out is a terrifying headline number.
Right.
If you look at Opendoor's Q4 2025 earnings release, you're going to see a net loss of $1.09 billion. That is billion with a B.
For a single quarter.
For a single quarter. If I'm an average retail investor, or frankly just someone with common sense, I see a $1.09 billion quarterly loss, and I immediately think, game over. Turn off the lights. The meteor has officially hit. How is that not an immediate red flag?
And you wouldn't be alone in that reaction. Wall Street algorithms certainly panicked at that number initially. But what's fascinating here is the illusion of that specific metric.
Illusion.
Yeah. The analysis report breaks down the math behind that headline loss, and the context changes everything. Of that $1.09 billion loss, a staggering $933 million was actually a non-cash charge.
Wait, before we move past that, for anyone listening who isn't a forensic accountant, what exactly is a non-cash charge? Because to me, losing almost $1 billion sounds like actual dollars leaving a bank account.
That is the critical distinction. A non-cash charge means no actual cash changed hands or left their corporate bank accounts during that quarter for this specific expense.
Okay.
In this case, that $933 million was paper loss explicitly for debt extinguishment.
Debt extinguishment.
Right. What this means in practical terms is that Opendoor looked at their complicated, expensive legacy debt, the loans they took out years ago to buy all those houses, and decided to aggressively restructure and wipe it out. From an accounting perspective, Retiring that debt early triggered a massive penalty on their income statement. They basically ripped the Band-Aid off all at once.
So they took an accounting hit on paper to free themselves from the actual literal interest payments they would have had to make over the next decade.
Precisely. It's a harsh accounting reality for that specific quarter, yes, but it absolutely does not reflect the daily cash flow of their core business operations. If you want to know if a company is actually bleeding to death, you don't look at a one-time debt restructuring charge.
You look at operations.
You look at their operational health. And operationally, things are actively improving.
The data in the report you provided backs that up perfectly. It focuses heavily on something called adjusted EBITDA. Now, why do we care about that specific acronym instead of just looking at the bottom line?
Because adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, that strips away all those weird one-time accounting events like the $933 million debt charge.
So a cleaner view.
Much cleaner. It gives you a more accurate picture of a company's day-to-day operational profitability. Are they actually making or losing money on the core act of buying and selling homes?
Got it. And when you look at that cleaner metric, the story completely flips. For the full year 2025, Opendoor's adjusted EBITDA loss actually shrank to $83 million.
Which is a huge shift.
Right. I mean, obviously, nobody throws a parade for an $83 million loss, but you have to compare that to 2024, where their loss was $142 million. That is a tangible, significant improvement. Their core business of flipping houses is getting demonstrably healthier.
It's a classic case of why you have to read past the headline numbers. That $1.09 billion net loss is just the ghost of the past being officially exorcised from their books.
Exercise from the books. I like that.
The $83 million adjusted EBITDA loss is the reality of their present trajectory, and that trajectory is clearly marching toward actual profitability.
Which brings us to how they actually pulled this off. The analysis report calls this their balance sheet miracle. And to understand the miracle, we kind of have to talk about the pain.
Oh, there was plenty of pain.
Let's really paint a picture of that brutal high-rate environment of 2023 and 2024. Opendoor was drowning. They had multi-billions of dollars of debt, and all that capital was tied up in old, unprofitable housing inventory. They'd bought thousands of houses at the peak of the market.
Well, before the music stopped.
Exactly. Then the market cooled dramatically because of the interest rate hikes. So suddenly, they're holding on to assets that are losing value every single day, while simultaneously paying exorbitant interest rates to the banks that lent them the money to buy the houses in the first place.
If we connect this to the bigger picture, holding on to that depreciating real estate inventory is like holding on to melting ice cubes while paying a premium rental fee for the freezer.
That is a mathematically fatal position.
It is. And this is the exact scenario that made Zillow and Redfin hit the panic button. But the analysis report outlines the tactical brilliance of Opendoor's turnaround strategy during this period. Instead of holding out hope that the housing market would miraculously reverse and save them, which is a huge psychological trap, a lot of struggling executives fall into Opendoor. Opendoor was just ruthless.
Ruthless how? Like, what do they actually do?
They aggressively liquidated that bad inventory. They didn't wait around. They didn't hope for a better spring selling season. Think of it like realizing you bought a bunch of overpriced winter coats right as summer started.
Right.
Instead of paying a fortune in storage fees, hoping winter comes back early, Opendoor just put them all on a massive clearance sale. They took a loss on the sale price of the homes, sure, but crucially, they stopped paying the carrying costs. They stopped the bleeding.
And here is the wild part. By aggressively selling off those old, losing properties, the analysis report notes they generated over $1 billion in operating cash flow in 2025. Over $1 billion, just from flushing the bad inventory. Now, if I'm a CEO of a struggling tech company and I suddenly free up $1 billion, my immediate temptation is to try and grow my way out of the problem. I'd want to buy new houses just to keep my top-line revenue looking good for Wall Street.
And that is exactly how companies dig their own graves. But Opendoor exercised extraordinary corporate discipline here. They didn't take that $1 billion and go out on a buying spree. They chose survival over artificial growth.
They paid down the debt.
They took that cash and systematically paid down their lenders. They deleveraged almost the entire company.
Which leads to what I think is the most staggering statistic in this entire analysis report. Today, after suffocating under multi-billions in debt just a couple of years ago, Opendoor's total debt sits at an incredibly lean $193 million.
From multi-billions down to 193 million.
Unbelievable.
They underwent the ultimate macroeconomic stress test. It was a crucible that literally killed the iBuying divisions of their much larger, better-funded competitors. But Opendoor walked through the fire, burned off the dead weight, and came out the other side with a pristine balance sheet.
It's an incredible survival story. But like you said, surviving is only step one. Now we have to look at the competitive landscape today, because this is where the dynamic completely shifts in their favor. So Zillow is out. Redfin is out. Who is even left in this space?
According to the analysis report, Opendoor's only remaining direct competitor in this space is a company called OfferPad, ticker symbol OPD. OfferPad is what the report refers to as a pure-play competitor.
Pure play meaning all they do is iBuying, just like Opendoor. They don't have a giant portal business like Zillow to fall back on.
Exactly. They are singularly focused on this one business model, but the comparison really stops there, because right now, OfferPad is essentially operating like a microcap company.
A microcap, you mean they're functionally irrelevant to the broader real estate market?
Pretty much. They're playing pure defense. They're just trying to conserve whatever capital they have left. Just to give you a sense of scale from the report in Q4 2025, OfferPad's home acquisitions shrank by 71% year over year. They bought a grand total of 110 homes.
Hold on. 110 homes in an entire quarter.
Across the whole country.
For a company trying to operate a national real estate model, buying roughly one house a day across the entire United States is basically a standstill. They're curled up in the fetal position.
They are, which means they are absolutely zero threat to Opendoor's market share.
And here's where it gets really interesting. Because while OfferPad is shrinking by 71%, how is Opendoor doing? I know they cleared their debt, so their hands are untied. Are they still shrinking too?
Not at all. The analysis report shows that Opendoor's Q4 home purchases actually surged by 46% sequentially. They are aggressively ramping up their acquisition engine while their only competitor is powering down.
So they basically starved out the competition. Zillow quit, Redfin quit,
Sure.
OfferPad is on life support. Opendoor essentially owns the entire playing field now.
It is the textbook definition of market dominance by default. Because the major players abandoned the field, Opendoor has emerged as the undisputed king of a newly consolidated market.
But I have to ask, if they're ramping back up and buying homes again, aren't they just going to make the exact same mistakes they made in 2021? What stops them from buying a bunch of overpriced houses and ending up right back in billions of dollars of debt?
That is the most important question to ask. And the analysis report dedicates a significant portion to explaining why this time is structurally different. They call this new phase Opendoor 2.0. The entire underlying mechanism of how they value and acquire properties has shifted.
So it's not the same algorithm.
No, they aren't just using the legacy algorithms that got them into trouble. They have completely overhauled their pricing engine with advanced AI.
How does that actually differ from what they were doing before? Or even from what a normal human appraiser does? Because a human appraiser usually looks at comps. You know, what 3 similar houses down the street sold for over the last 6 months?
Right, and the problem with human comps, or even legacy algorithms, is that they are inherently backward-looking. They tell you what the market was, not what it is.
Okay, that makes sense.
Opendoor's new AI models are processing vast amounts of real-time telemetry. They're analyzing hyperlocal neighborhood microtrends, real-time material costs for renovations, even subtle shifts in local buyer demand, all instantly. They are feeding this machine entirely new data based on the current normalized housing market, not the pandemic-era bubble data that skewed their old models.
Okay, but anyone could say they have a shiny new AI. Does the data in the report actually prove it works?
It does. The analysis report specifically isolates what they call the October 2025 cohort. This refers to the specific group of houses Opendoor bought in October 2025 using this brand new AI pricing model. And the early returns are phenomenal. That specific cohort is currently tracking as Opendoor's most profitable October on record.
Most profitable ever. Wow. That is a huge validation of the new model. The AI isn't just buying houses, it's accurately pricing in a reliable profit margin right from the start.
Exactly. And this early success has emboldened management to set some incredibly aggressive forward-looking targets. According to the report, they're targeting 6,000 quarterly home acquisitions as they exit the year 2026.
6,000 a quarter. Think about the scale of that compared to OfferPad's 110 homes.
It's a totally different stratosphere. And the ultimate goal tied to that 6,000 number is what investors really care about. Management is targeting adjusted net income profitability by the end of 2026.
But not just shrinking the loss.
No, generating actual verifiable profit.
Which brings us to the final piece of this deep dive for you to consider the valuation verdict. Let's talk about the actual stock, the bull case for Open.
Because if I pull up the stock ticker right now, I am going to see a negative PE ratio. And I don't know about you, but if I'm looking at a stock and I see a negative price to earnings ratio, my instinct is to run the other way.
Naturally.
It usually means the company is fundamentally broken and losing money on every single share. Why should we, or anyone listening, ignore a metric that is traditionally a giant red flag? Because in this highly specific scenario, that negative PE ratio is a temporary optical illusion. Remember their $933 million non-cash charge for retiring their debt.
Right, the massive accounting hit.
That massive charge officially depressed their earnings on paper. Because the E in PE, the earnings, is artificially skewed by that one-time debt payoff, the entire ratio is useless for evaluating the company's future potential. It completely obscures the underlying value of the core business.
So if PE is useless right now, what metric does the analysis report suggest we actually look at?
The report points straight to the price-to-sales ratio, the PS ratio. It is a much cleaner metric for a company emerging from a massive transitional phase because it compares the stock price directly to the actual revenue the company generates, completely ignoring the weird accounting noise of the debt payoff. And right now, Opendoor's price-to-sales ratio is sitting at roughly 0.83x.
0.83x. Let that sink in for a second. That means the entire company is currently trading at less than 1 times its actual revenue. You're essentially buying the stock at a discount to the raw cash flow the business brings in from selling homes.
It is a profound discount. It implies the market is still pricing Opendoor as if it's struggling under that old mountain of debt, entirely missing the fact that the debt is gone.
And if you track the stock's dramatic journey, it tells a wild story of investor sentiment. This stock crashed all the way down to 51 cents a share. 51 cents.
Which is priced for absolute, imminent bankruptcy.
Exactly. But as this turnaround story has started to quietly prove itself, as they cleared the debt and the AI started showing profitable cohorts, the stock surged past the $5 mark.
The broader market is slowly waking up to the reality of the balance sheet cleanup. They are realizing the meteor actually missed.
So what does this all mean for you and the research you asked us to look into? The analysis report delivers a very clear bottom line on the bull case. With the stock currently sitting around a $5.18 price point, we're at a critical juncture. If Opendoor's new AI algorithms hold up, if that highly profitable October 2025 cohort wasn't just a one-off fluke, and their profit margins continue to expand as they scale up toward buying 6,000 homes a quarter, then this 5.18 mark might not be the ceiling of a lucky bounce.
No, not at all.
According to the analysis report, 5.18 might just be the concrete floor for the stock's next major leg up.
They removed the anchor of their legacy debt. They survived a macroeconomic storm that basically starved out their competition. And they refined their core operational engine with a highly accurate AI model. The structural groundwork for significant profitable scaling is completely laid out.
It is an absolute masterclass in corporate resilience. To synthesize everything we've unpacked for you today, Opendoor went from being an iBuyer that the entire financial world left for dead, suffocating under billions in debt and holding terrible real estate. But instead of folding like Zillow or Redfin, they made the brutal choices. They liquidated the bad assets. They cleared the ledger, bringing their debt down to a microscopic $193 million.
All while their competitors shrank into irrelevance.
Exactly. Now they are rebuilding their entire acquisition model with AI. They survived the fire, and now they basically own the playing field.
This raises an important question, though, one that goes beyond just the stock price and touches on the future of how we all live. If Opendoor's new AI algorithms are truly that accurate at pricing homes profitably, and they are now operating in a heavily consolidated market with virtually no direct corporate competition, what happens to the traditional real estate market when a single, unopposed tech giant effectively sets the baseline price for neighborhoods across the entire country?
If they become the default buyer, they essentially become the default market maker for American housing. That is a fascinating, slightly terrifying, and incredibly important thought to end on. I want to enthusiastically thank you for sending over this analysis report and joining us on your deep dive today. We covered a lot of dense financial ground, from debt extinguishment to AI pricing models, but these are exactly the hidden narratives that truly drive the market. Stay curious, keep exploring the unexpected stories behind the numbers, and we will catch you on the next one.
Don't forget to like, share, and subscribe for more.